From New York City for our viewers worldwide, I'm Taylor Riggs in for Jonathan Ferro. Bloomberg Real Yield starts right now. Coming up, the payrolls report highlighting a robust labor market, prompting traders to bolster bets on a bigger rate hike, and of course, leading to yet another inversion of that yield curve. And that is where we begin with the big issue, keeping the Fed under pressure.
The data is really strong.
The economy is red hot. The labor market is red hot.
It's a white hot labor market.
This is really a Fed now that is in inflation fighting mode.
The Fed is late. The Fed knows it's late.
They do have to move pretty aggressively.
They go 50 in May. That's the new hike.
The markets, from a pricing standpoint,
suggest that there's a 50 basis point hike on the horizon.
They're going to do 50 basis points. Why wouldn't they?
Data dependent is certainly the name of the game.
Inflation is going to be absolutely insane for March.
It has to hike until there's some kind of pain.
We're looking for 50 basis points in May as well as June.
Maybe a couple of 50 basis point rate hikes.
We shouldn't ignore the data.
The Fed will try to be data dependent.
Joining us now, Franklin Templeton's Sonal Desai, Morgan Stanley's Jim Caron, and James Athey of Aberdeen Asset Management. Great to have you. And I think on a Friday when John Ferro is out, I like to joke and say that we're renaming the show Yield Curve instead of Real Yield, because that's really where I am focused, of course, on today on this big jobs day. And Jim, that's where I want to start with you. As you think about a Fed and a lot of economists and analysts thinking that the Fed needs to move, they need to move faster, they're maybe looking at 50 basis points. Is that what this further inverted yield curve today is telling you?
It absolutely is, and it's telling you that the economy is strong today, but it may not be in the future. And this is where the debate is being had. It's being had along the yield curve at this point. So I agree. Look, I think a 50 basis point rate hike in May and a 50 basis point rate hike in June is very, very much on the cards. But eventually, what I think the markets are also telling us, and it's telling us this through the yield curve, is that maybe by late 23 to 2024, that we may have a more significant slowdown and possibly even a recession. It's telling us one other thing. It's telling us that the Fed's policy reaction function right now has moved very, very much towards fighting inflation, which means that if they don't get what they want, expect them to be even more hawkish. So right now we're expecting 2.8% for the policy rate in 2023 and 2024. If we don't get inflation numbers down, they'll move that up to 3%, even as high as 3.5%. The bottom line is that they're going to do whatever it takes to get inflation under control. And if that means an inverted yield curve, they're going to do it.
Sonal, is that what you see as well, that clearly the shift has gone back to inflation while, of course, still focusing on the full employment picture, but the priority maybe has shifted?
So for what it's worth, I've been saying this for about a year and a half now. So it is a while that I've been worried about inflation. I think that what we're seeing, the geopolitics has simply made it something that is not possible to ignore anymore. This was already happening from Q4 of last year. Absolutely. I think that for the better part of a decade and a half, the market has been privileged, I would say, over the real economy because inflation was low. And the Fed could afford to essentially cave in every time the market got a little bit nervous. And so I would say that absolutely the Fed is going to do more. I would actually go further than Jim. I think that they are likely to end this hiking cycle closer to 4 than to the 2.8. And I think a lot of it is going to happen between this year and next year.
It's interesting, James Athey. I want to bring you into this. In the meanwhile, we're getting some further comments, right, about a growing list of banks that are now boosting those rate hike expectations. JP Morgan is one of those, and they are saying that, quote, not wanting to fight the Fed or their itches, we are now replacing our expectations for 25 basis point hikes in May and June with 50 basis point moves, reverting back to 25 basis point hikes in July and thereafter. James, do you see that, this violent move that you describe in your notes today, this violent reaction in the bond market, sort of a signal that we have to front load a lot of these hikes and then slow it down as we reevaluate come summer?
Yeah, I mean, the Fed's
trying to buy some credibility here, right? They've been behind the curve as the other guests have already spoken about. And so the Fed really is having to buy credibility. It's a horrible situation to be in because, so much of this inflation really is outside of their control. I mean, in much the same way, actually, as the disinflation which preceded it was largely out of their control. But that's another story. This is a lot of supply side input cost, global inflationary pressure we're seeing in most regions across the globe. The Fed doesn't really have any tools to deal with that, but it can deal with the second round effects. And that's what it's trying to do here. It's trying to, prevent both real actors in the economy and financial markets from getting to a place where their expectations and their behaviors allow inflation to become a self-fulfilling prophecy. So I think they are going to be aggressive. And until, financial conditions of broader markets react in a more negative fashion, the door is open for the Fed to be much more aggressive.
Sonal, comment here on what James said, because he's right in that a lot of the inflationary pressures are due to supply chain issues. That's not something that QE can fix. It was out of the Fed's control. But like you said at the beginning, you've been warning about inflation for a year, and most economists on this program have said for at least a year it wasn't transitory. And yet the Fed almost insisted in continuing to say it was transitory. Is there more that the Fed can do as they think about maybe sort of ignoring the transitory effects if they miss that boat and looking at inflation that they can control?
So I actually would break it down into different pieces. We had the absolutely correct policy in 2020 when the Fed did in one fell swoop in a matter of months, QE 1, 2, and 3, put together. That's because we shut the global economy down. In particular, we shut the US economy down in March of 2020. But the big difference, I think, and something which was definitely within the Fed and policymakers' control, is the fact that that monetary expansion went together with massive fiscal expansion. And the part of the fiscal expansion, which was correct, also happened in 2020. But by 2021, it was pretty clear we had vaccines. Economies were on the verge of reopening. There wasn't really any need for the massive fiscal expansion we continued to see hand in hand with continued monetary easing, which to me, the remarkable thing is, this continued after the Fed acknowledged inflation wasn't transitory, which was in December. We continued to expand the balance sheet, January, February, March. So if I look at it, could the Fed do more? Well, yeah, actually it could. And absolutely, it does not control what happens in geopolitics. It could not have controlled the supply chain bottlenecks, which ended up being far more serious than any of us had anticipated. And this emerged in the in the second half of last year, that, bottlenecks weren't going away. But that earlier stuff, that was kind of policy driven, and it could be policy fixed.
Right. Yeah, very interesting. Jim, on that note, let me bring you back in here as you think about sort of peak yields. And I'm curious, as we shift from all of the QE that Sonal just described into, well, maybe QT, right? Not only being liftoff, but also looking at the balance sheet. Have we seen peak yields? Is this a market that is now preparing for lower yields on the horizon?
I don't think so. I think that yields will continue to climb higher as inflation expectations continue to rise. Look, just to further what Sonal is saying is that what the Fed is faced with right now is a supply shock that is pushing inflation higher. We call that cost push inflation. Fed policy is not designed to actually address that. It's really designed to address the demand side of the economy and to slow or increase demand, whether they're hiking or cutting interest rates. So the only thing that they can really do, we have to go back to Paul Volcker, is to really control inflation. What they have to do is really, really slow demand down by either risking or creating a recession. And that's typically the way the Fed has operated over the years, is within their 3-year business cycle or whatever the case may be, is that you get this boom bust type of a cycle. So I think what's important here is that the Fed wants to keep inflation expectations anchored. Right now, I think they fear that they're becoming unanchored, which means that inflation can spiral continuously higher until they break its back. But it's not going to be like a Fed rate hike lowers oil prices or a Fed rate hike lowers food prices. That has nothing to do with it. All they can do is really try to address the demand and bring the demand down such that prices may eventually come down. And that's the outcome that the Fed really doesn't want, because that causes a hard landing. They're trying to engineer a soft landing. So this is the challenge. So quantitative tightening is certainly that's probably on the table at the May 4th meeting. It's likely going to happen. It's going to push yields a little bit higher. I would not be surprised to see the 10-year note in the 2.5 to 3% range. Could even peak up a little bit above that.
Really interesting. Jim, it's interesting as you talk about that, sort of the anchoring of inflation expectations. I'd been watching a lot of the long end break evens, the 10s and the 30s that had really started to lift up, maybe signaling a de-anchoring of those longer term expectations. And that's when we'd spoken with Muhammad Al-Arian earlier, talking about, well, if that sort of is signaling that we've already made that policy mistake. Take a listen.
I worry that the Fed now has to choose between one of two mistakes. I worry that they'll tip us into recession. That's what I worry about. That they are late, that they mischaracterized inflation for too long, they didn't do enough, and now they feel that to regain their credibility, they have to show, and they hike twice by 50 basis points.
I mean, Jim, could you not argue that 7.9 print on CPI means that the mistake has already been made?
Absolutely. So it may require a recession. It's not just a risk. It may require a recession in order to get inflation under control. That's the risk that we're facing. The point is that if inflation doesn't come down because the economy slows due to all of these higher energy and food prices and things like that, if it doesn't come down, the Fed is willing to take this risk of a hard landing. And that's the main point.
James, you bring us such a good global perspective. It's interesting talking about maybe perhaps this year no longer the coordination of these global central banks. We've talked a lot about China even reversing and easing. I want to get your perspective on an ECB as you think about a Fed that is hawkish and tightening and an ECB that's trying to pivot, but are they pivoting fast enough as well? I was looking at the Eurozone inflation numbers this morning. It's 5, 6, 7, 8%.
Yeah, I mean, no is the quick answer. As Sonal has described with respect to the Fed, the fact of the matter is they were still expanding the balance sheet all the way up until a few weeks ago. I mean, they have become accustomed, in much the same way as investors have been Pavlovian conditioned to buy every dip. Central banks have become accustomed to a world which was, permitted them, shall we say, to act slowly and cautiously and steadily and carefully. There weren't really any inflation shocks around the corner through that period, and the paradigm shifted quite dramatically, and their behavior really has been, characterized by fighting the last battle, shall we say. The ECB's problem is myriad more complicated than the Fed's problem because of the nature of the monetary union, the divergence of economies, and the ECB is absolutely terrified of causing the sort of bond market ructions that we saw last time they engaged in a sort of ill-fated attempt to tighten policy to deal with the sort of inflation that really wasn't driven by demand conditions. So I think the ECB is caught between a rock and a hard place. They're again trying to buy sufficient time to allow inflation to normalize on its own. That's what they're hoping for. And I think they will therefore continue to drag their feet relative to everyone else. They're still buying bonds, and they will still likely be buying bonds until at least June. So I think personally the market's probably a little bit aggressive with respect to ECB rate pricing here.
We'll get, of course, we migrate from full faith and credit from central banks into what it means from credit, investment grade, high yield. We're going to do that next. Sonal, Desai, Jim Caron, James Athey, everyone going to be sticking with me around the table. Up next, our auction block, high yield. Those borrowers staying at home amid all of this surging inflation and a more hawkish Federal Reserve. That conversation is up next. This is Bloomberg. This is Bloomberg Real Yield. I'm Taylor Riggs in for Jonathan Ferro. Time now for the auction block, where we want to kick things off in Europe with a 10th consecutive day of issuance to close out the quarter, helping push monthly volume to above 172 billion euros. And back here in the U.S., high-grade bond sales topped about $230 billion in March. That's the fourth most month for any month on record. And the junk bond market pricing just about $43 billion this quarter, capping its slowest first quarter since 2016. Sonal, Desai, Jim Caron, James Athey still with us. Sonal, start with me about credit. I think what was so fascinating has been the big sell-off in credit. When you think about high yield and that shorter modified duration and the protection that provides, why aren't we seeing that? Are you seeing more cracks in the credit space?
So I wouldn't go as far as saying broad-based cracks, but I think it's just generally some concern about credit. I think actually, if you look in the high yield space, over the past few months, we've seen more attractive opportunities than we have seen in quite a while. So I don't think people are automatically jumping in to buy dips because they're anticipating continued sell-off. But I would say that that's a part of it. What you're seeing is just a greater degree of care in terms of picking.
Jim, it's interesting. I think we spoke with Bob Michael over at JP Morgan a few weeks ago, and he had hinted that the sell-off had been so severe, valuations were so attractive, it was hard not to jump back into the credit space. As you look at spreads and also perhaps maybe the differences in modified durations, how are you viewing credit?
So I think the initial conditions matter a lot. So, typically whenever you get a potential slowdown in the economy or the Fed is hiking interest rates that might induce a slowdown, you tend to look for places of weakness, places of over leverage. And right now, we don't really have a tremendous amount of that. We have a lot of debt, but the interest servicing costs are really, really low. Corporate balance sheets are flush with cash. Personal balance sheets are very strong. The jobs market is very strong. Delinquency and default rates amongst consumers is very, very low. So there's not an obvious catalyst what would drive default risk very, very high and ultimately hurt credit. The two sectors that typically do that are financials and energy. The energy sector is very strong just because of commodity prices. The financial sector has been so heavily regulated that the leverage isn't very, very high there either. So what that means is that even though the yield curve might be indicating that there could be a slowdown in a year and a half's time, the real issue is that it might be a mild slowdown. So if we do get a recession, it's a mild recession. So therefore, default risks really don't move a whole lot higher. And what that also tells us is that it does become an opportunity when things get cheap enough. I don't think they are right this second, but when they get cheap enough, it is an opportunity to go back into credit.
And James, this is interesting because sort of looking at the other side of that is Goldman Sachs. When they were looking at the credit markets and looking at reducing some of the risk, they said, quote, from current levels, we think spreads have likely reached the low end of their range. And I'm taking a look at credit spreads of just about 325 basis points over treasuries in the high yield market. How are you thinking about the range that we've been in as of late?
Yeah, so I mean, I kind of share a lot of Jim's observations there. I certainly think that's a big part of the more positive side of the credit outlook. But a couple of things to me. First and foremost, I think the market in general is underestimating the potential for recessionary conditions to happen a little sooner. Essentially, what we've experienced in this cycle is everything has happened at 2 or 3 times at the usual pace, and I have concerns that we might see similar conditions, as we go through this late cycle Fed hawkish process. So I think maybe there's underestimating how quickly things might slow down, and I also think averages and aggregates, as is often been the case recently, don't necessarily describe the full distribution. So there are a lot of companies that's starting from a stronger position, shall we say, in terms of balance sheet and cash on hand. But I think there are some weak links in the chain, and then ultimately liquidity. Whenever risky assets are rallying, it's normally because of Fed policy and liquidity provision, and we haven't even started the balance sheet unwind. And I think as we see liquidity being taken out of the market, I think that's going to continue to pressure risk assets lower. So the combination there, I'd be more in Goldman's camp here. I think we're going to see further spread widening, and I think if the Fed delivers on the kind of policy that it's suggesting at the moment, we might see some weak days, weeks, and months for the credit market.
So now let's just round it out with you to top it off, since that's where we started. As you're thinking about QT, as James just mentioned, pulling out some of that liquidity in the market, does that change at all a thesis as we have pivoted from QE and sort of this unlimited zombie companies are alive everywhere into QT?
So I think that I tend to be somewhere between James and Jim, actually, because I don't think recession is necessarily imminent. The strength of the labor market is very real. I also don't think I think that balance sheets are genuinely strong. So I'm not sure we have as many zombie companies around as we have had in previous episodes of expansion, for example, 2008, for just for comparison's sake. I would say that if we see QT, I would be somewhat more concerned on the IG front in some ways, in part because of that greater duration at that end. But as we come out, there will be better buying opportunities than we have perhaps right now. Right now, you have to be particularly careful in terms of checking where you are investing. There are clearly going to be sectors which benefit from the current environment, but many which will be hurt.
Really appreciate it. What a great roundtable. Sonal Desai, Jim Caron, and James Athey. Everyone going to be sticking with me one more time because still ahead, the final spread, all about the week ahead. We're featuring plenty of Fed speak. You have FOMC meeting minutes. All those conversations up next. This is Bloomberg. This is Bloomberg Real Yield. I'm Taylor Riggs, and again for Jonathan Ferro, his loss is my gain because it is time for the final spread. A look at sort of what's coming up in the next week up ahead. U.S. PMIs, ISM services, initial jobless claims, all of those are coming throughout the week. And we're also going to get some big Fed speak as well. You've Brainerd, Williams, Harker, Evans, all of those on the calendar. And the FOMC meeting minutes, those are coming on Wednesday too, closing out with a big RBI rate decision on Friday. Sonal Desai, Jim Caron, James Athey, still with us. It's hard to push forward on to next week when we're already here on Jobs Day, which what feels like a pretty big day. But Sonal, as you think forward, what do you want to hear most when it comes to next week?
I think we're probably going to be looking at further confirmation of a fairly uniformly hawkish Fed guiding the market, giving the market a chance to start pricing in more and more. Essentially, once it's priced, the Fed will deliver because that's an easy win for them.
Jim,
so that's what I'd be looking at.
We only have about a minute left. Jim, your take on next week?
I think the Fed is going to really emphasize that they're here to fight inflation. They're very serious about it. They're going to do whatever it takes. And I think they're also going to start to talk more about the balance sheet. So start looking forward to that.
James?
Yeah, so maybe I'll take the under on the front end. I think we've gone a long way quickly, and we are pricing what looks to be a pretty accurate but fairly aggressive path. So maybe we see a bit of stability there. But I agree with Jim. I think maybe the balance sheet comes front and center, and that's something the market's going to have to work out exactly how that's going to play out.
What a pleasure to have all of these three guests with me on this very important Jobs Day. Sonal Desai, Jim Caron, James Athey, really, really appreciate it on this Friday. It is crazy. It was a day that we got another inversion of that yield curve. I'm currently looking at a 2s 10s, gets more inverted. Now almost -7 basis points on the day, a 2s 30s. The first time since 2007 we've gotten inversion, -1 basis point as we're renaming the show Real Yield to Yield Curves, inverted yield curves. From New York, that does it. From same time, same place next week. That was Bloomberg Real Yield, and this is Bloomberg.